Let's welcome on the show now a very special guest to talk about fixed income investing. Vikas Garg, the head of fixed income with Invesco Mutual Fund, joins us now on the show. Mr. Garg, thank you so much for taking out time and talking to our viewers on the Money Show. This is an audience retail in nature that does not necessarily understand the nuances of fixed income investing. It's quite a complicated topic as well, right? With all the jargons, durations, maturities, interest rates, the macroeconomic environment bearings as well. So I hope that with this conversation we're able to ease all of that out for our viewers. So to start with, but Mr. Garg, if you could talk to our viewers about why it's important to have not just equities and equity mutual funds in your portfolio, but also a little bit of fixed income as well.
Thanks a lot, Mubina, for having me on your channel. And let me just, correct the observation that you made in the opening remarks. So fixed income is not at all a very complicated market at all. We have various other different markets which are much more complicated, I would say. And fixed income is a much more simpler as compared to many other markets. I think the fallacy is that people really don't talk much about the fixed income market in a way, but then they don't realize that, a large part of their investments are already into the fixed income through the savings or the fixed deposit which they create with the banks. So it's a very simple product. I think it just needs some bit of awareness. And that is how I think the channels like yours are spreading the awareness to the investors. Now, coming to the question, I think fixed income has to be seen as a part of a core allocation for anyone, just the way anyone looks at the different asset classes like equity, gold, real estate, etc. Even a fixed income should be a part of a core allocation. In fact, it is much more beneficial for everyone to have a bit of allocation to the fixed income because statistically looking, if you were to look at the volatility of fixed income category vis-a-vis the other categories of the asset classes, it's much lower. So it has its own advantages of adding some bit of a fixed income allocation into the overall portfolio. And I think a very important point also is there that this asset class has a very low correlation with the other asset classes. And in fact, in some of the times, it can also give the negative correlation with other asset classes like equity in some of those specific time frames. So I think overall fixed income does a very important role in terms of reducing the volatility of the entire portfolio. And that is how it should be seen more like the part of the core allocation which has to be there. Now, just like the way on the equity side, we understand we have those categories like large caps, mid caps, and the small caps. And all of those categories have their own inherent risk and also the rewards. Similarly, on the fixed income side, we have different products altogether. In fact, I think this is one of those asset classes where the spread is like there from 1 day investment horizon to all the more like 15-year plus kind of investment horizon as well. So there's a product which can suit everyone in terms of requirements. And the simple basic rule is that, one goes longer on the duration, gets introduced to more of a volatility. So just like, as I said, in the equity side, you have different categories with different volatilities. Similarly, on the fixed income side, you have different product classes altogether with a different volatilities in a way. I think a good part to understand over here is that the regulator has been working quite well in terms of kind of ensuring a very transparent kind of a mechanism for every investor to look through the fixed income portfolios. And in that aspect, most of the schemes on the debt side have been, kind of restricted by the regulator from a duration perspective. So as I said, going longer would mean a higher volatility. And that is where I think the regulator has given that much of a visibility for each and every particular scheme, which has to operate in a defined boundaries of a duration profile. So that way, exactly an investor would know what he or she is getting into when investing into any kind of a product category of fixed income side. Another very important thing is that, I think the fixed income market is not very much exposed to the idiosyncratic risk. And if you were to look at the returns of many of the product categories over the last 3 to 5 years, I think the dispersion between the worst performer and the best performer would be just about 1 to 3%. That is what I'm talking about, the high quality AAA oriented bond funds in a way. So, I think it's more of a function of you choosing the product category in a prudent way, in depending upon your requirements. Once that is done, I think in that all the funds possibly would have a similar kind of a return, or at least there would not be that much of a disparity in terms of returns of a particular fund versus the other. Another important thing is that the volatility can also come from the credit side, and that is where I think it becomes much more critical for one to understand the credit quality of the fund which one is getting into. My sense is that one can afford to be slightly wrong on the duration side, but one really cannot afford to be wrong on the credit side, because one bad asset into the books of any portfolio can actually create or wipe off the substantial part of the returns from a total return of a portfolio in a way. So I think fixed income, as you said, it's a very critical asset class. It should be mixed with the portfolio so as to reduce the volatility for the investors and possibly look at more constructive in a way to be able to meet the goals that one would have.
Mr. Garg, you mentioned a very interesting point, and that is that the volatility in debt funds is not as much. If you have to take the highest return generating fund versus the lowest in fixed income, there will not be too much difference. So, yes, there will of course be volatility because that's the course of the markets. But would you say then that debt funds, fixed income funds, maybe carry a little lesser risk compared to equity funds?
No, I think it's a function of the returns which one is aspiring for. So no doubt, different asset classes would have a different returns aspiration, and that is how the volatility in the form of a risk will also get introduced. So both the things have to be put into a perspective over here. So I think, debt class is a separate asset class altogether. It should be more compared in a way that some asset class which can give more sustainability or I would say the steady income to the portfolio, while the equity possibly is something which gives the capital gain in a very different way altogether, based upon the macros and based upon the stock price movements and all. And along with that, it also introduces a bit of a different kind of a volatility. Now, if you want to look at historically also, I think no doubt that equity class would have given much higher returns as compared to the fixed income class. But yes, if one was to look at in perspective of a risk-adjusted rewards, I think the both may become quite comparable with each other. It's more of a function of the risk appetite of each and every investor, wherein one is more keen to invest into the equity side or into the debt side, depending upon the risk profile of each and every one. But I think both the asset classes do a work of allocating into the asset classes suiting the requirement of the investor. And yeah, that's how both of them are complementing with each other, and that is how it should be seen from an investor perspective.
Okay, understood. Let's now talk about what's the right way then to find that balance between equity and debt. I know this will of course differ person to person, and what a person's profile is in terms of their time horizon, etc. But let's assume that someone who wants to invest for the long term, how can they find the right mix? What percentage should be in equity? What percentage should be in fixed income?
Yeah, no, I think you rightly captured. It should be a part of a risk profile of each and every investor. And what does the fixed income side do in terms of reducing the portfolio volatility? I think that is a function of risk profile of each and every investor in terms of deciding upon the mix of a debt to equity. Now, very broadly speaking, someone who has just started the career and looking for a very long-term investment, people talk about 80 to 85% of the allocation maybe towards the equity side when someone is just entering into the financial market. And as one reaches more towards the end of the career also, and maybe more towards retirement, that is when I think most of the allocation may still happen towards the fixed income side. And that is where I think between this kind of a mix, I think it depends more of the risk profile of the investor to decide whether it should be more in favor of a fixed income or the equity at any point in time. Two things I think which stands out quite well over here in favor of the fixed income product. One is that it plays a very constructive role in terms of the overall portfolio. Let's say if the portfolio has some bit of a risk features into it, depending upon the asset classes of equity or the gold or real estate. I think this can be a good ingredient in the form of a fixed income book over there, so as to reduce the overall volatility and thus the risk of the portfolio and make it more aligned with the risk profile of the investor. So that's one. Second, I think it plays a very complementary role to the other asset classes in terms of achieving a very specific financial goal. Let me give you the examples. So, let's say someone wants to buy a car, buy a house after 10 years or so, and for that he has to start building the corpus right now. So I think to begin with, more of the allocation may happen towards the equity side. Maybe 85% may go towards the equity side to begin with. But when one reaches closer to the specific goal, like a year short of the specific goal, that is a time when a lot of the investments have to be diverted towards the fixed income product, because that is what gives the steadiness or the lesser volatility of the returns when one is reaching closer to achieving the financial goals. Another example is for the retired people, where people would be looking for some bit of a very steady cash flows on a monthly basis to be able to, let's say, for example, take care of their livelihood. And that's where I think fixed income as a category can create a very prudent portfolio in terms of a matching of cash flow requirements for the investor, which something cannot be possibly done by the equity class. So I would say it depends upon the investor to
Absolutely, it's something that's very objective. I think we've just seemed to have lost Mr. Garg's feed. We'll try and reconnect. But yeah, I think what Mr. Garg has tried to do is just put you on that path so that you can start thinking in that direction. Okay, we've managed to get Mr. Garg back. Continue with your point, sir.
Yeah, so I was saying the fixed income plays two constructive roles. One is to reduce the portfolio risk in line of the risk profile of the investor, depending upon the appetite of each and every one. And second, it plays a very complementary role in terms of achieving the specified financial goals for each and every investor.
So, Mr. Garg, now there are so many kinds of different categories of debt funds, right? Like how you have in equities, large caps, mid caps, small caps, multi caps, etc. Similarly, in debt funds as well. Looking at the current interest rate environment, which debt funds, are poised to give good returns? Last year, we saw long duration funds giving double-digit returns. For the last, I think, 3 to 4 years, gilt funds, that's government security funds as well, have been giving double-digit returns. Where do you see the next phase of action?
So, moving on, no doubt that we are into a very unprecedented time frames where there is no set of a reaction function from the regulator or even the market participants. So we'll have to possibly see through what has happened in the last 1 year, where we got struck by the COVID-19 disruption. And that is when I think RBI sprung into action and, just to ensure their financial stability, I think they had aggressively cut down the interest rates and maintained a very benign liquidity situation in the market, which really was very helpful in terms of, no doubt, ensuring the financial stability and also looking at the returns, which you just said that all the long duration funds have done wonderful over the last couple of years. Now, I think we have come a full circle when we look at from a COVID-19 situation. Unfortunately, the cases are rising again, and that's where it looks like, looking at the last year behavioral pattern of RBI, at least our sense is that, RBI would stay very protective of the growth this year as well by using all the conventional as well as the non-conventional tools. And whenever, there is some bit of a resistance from the market participants in terms of the expectations from RBI side, that is where I think RBI may come out quite clearly and try to address those fears. No doubt, we may not be in that kind of a rally which happened over last year or so. The rate cut cycle has seen almost about 250 base point of a rate cut over last 2 years. And possibly now we are at a bottom level of the rate cut cycle. And we do not really expect much of a rate cuts to happen from now, given the situation. What is more pertinent over here, or the risk factor over here, is the RBI's unwinding of the policy measures which it has taken over last 1 year in the fight of pandemic. I think somewhere in the month of January and February, there were two concerns that RBI may sooner start the unwinding of the policy measures. And some of the market participants were also expecting it to start as early as April or June. And that's where we had seen some bit of a correction on the rate side in the month of January and February. Now, I think with the second wave, which has hit us, and we are back to square one in terms of the growth disruption, I think all those fears are pushed behind. maybe possibly towards the end of 2021 or even towards the end of financial year 22. So that gives like good 9 months to 12 months of a visibility that RBI would continue to maintain a very accommodative policy stance, and also along with that a very benign liquidity for the market, both of which is very helpful in terms of ensuring that the rates are possibly on a more stable side and remain with a downward bias. Now, looking at all the perspectives, I think 1 to 4 year space looks very attractive because that is the one which would be more anchored by the systemic liquidity, which continues to remain quite benign. And I think RBI has been time and again in ensuring that there is a significant amount of liquidity which is there in the system. So 1 to 4 year space looks very attractive from that perspective. Along with that, there is a very positive or a favorable demand supply dynamics for that 1 to 4 year space, because it looks like, as of now, most of the critical asset classes, which are like corporate bond fund, short-term bond fund, banking PSU, and even the low duration fund, which all put together would possibly be about 60 to 65% of mutual fund portfolios, is looking to invest into the similar 1 to 4 year kind of a space. And I think that's where we have seen a significant inflow over the last couple of months as well. So that gives a positive spin on our demand supply dynamics as well for that 1 to 4 year space. Now, looking at the longer end of the curve, I think while no doubt that the curve has been quite steep and the 10-year is closer to 6.25 kind of a level as of now, which is very steep if you were to look at over the repo rate. But then I think there's a reason why there's a steepness of the curve. And this reason is possibly coming from the inflation fears and the fiscal fears, which are there, with is kind of putting this steepness into the curve. I think RBI has been making all the attempts to control the yield curve through the unconventional tools like the open market purchase operations or the operation twist, or very recently announced the GSEC acquisition program calendar for the first quarter of about 1 lakh crores. So I think RBI has been making an attempt to kind of control the entire yield curve. But my sense is that the long end of the curve would still remain volatile, because still there's a huge amount of a supply which is to come from the state government and the central government, which has to be absorbed by the market. So more of the technicals, I would say the long end of the curve looks slightly more volatile as compared to the short end of the curve. So from that perspective, I would say, the people who are not willing to take the volatility to a great extent, I think 1 to 4 year space looks very attractive. And people who can have the stomach to absorb a bit of a volatility, I think some bit of an allocation in the longer end of the 10-year space also makes a point over here. So what we have been advising, especially to the people, who are looking for a mixed kind of an approach, the 75 to 80% of the allocation may still go towards the core book, which is like 1 to 4 year. Two things: one, that it gives lesser volatility, and second, it also gives the reinvestment opportunities at a later date, possibly at a higher rate as and when the interest rates were to go up, possibly over next 1 year or so. At the same time, have about 15 to 20% allocation to the 10-year space, because that's what it gives a very high accrual or a very high carry, which is very attractive. But yes, one has to be slightly more mindful of the volatility that can be there into the 10-year space as well.
Okay, understood. Now, another question I want to ask you, and this again would be a little more investor specific, but I'm just going to sort of ask you in a more broader paintbrush. Again, keeping it with those individual categories, different investors have different goals in mind, right? Some of them may be saving up for a child's education, which may be up in the next 3-4 years, or purchasing a house, again, maybe up in 5-6 years. So depending on these goals, what sort of category do you think is best suited for them?
So again, coming back to the basics, I would say, if someone has a requirement of the funds over next 3 to 6 months, then one has to definitely invest into those categories which are towards the shorter tenor of the segment. And the scheme categories like liquid funds, ultra short, money market, and to that extent, a low duration fund category, which has a mandate of investing, let's say, up to 1 year of a duration of the fund, would do the purpose for that kind of a requirement for the funds. And someone who is looking to, kind of invest for a 3-year plus kind of a horizon, I say that it becomes then a part of a core allocation of the book. And then it comes to the same basic, what is the rate cycle that we are into as of now, and how do we see the rates panning out going forward? And that is where I think one has to play a very active role in terms of keep shuffling between the tenors so as to be able to kind of make more returns than possibly having some kind of a passive roll down strategy. So from that perspective, let's say coming to your examples of requirements, someone looking to buy a car 3-4 years later, or someone even looking to buy something else for a longer time frame, I think it comes to the question of a core allocation. And to me, at least as of now, it looks like a 1 to 4 year space is a part of a core allocation with about 75 to 80% allocation over there, which gives the benefit of low volatility and also the investment opportunities at a higher rate. And about 15-20% can still be into those 10-year plus kind of products, so as to give the benefit of a accrual carry or a higher carry over there. I think that's a myth, which many of the people say that, if you have a 10-year investment horizon, then you should look at a product which has a 10-year investment profile. Now, that's not required at all because, as long as you are investing into a fixed income product, it is a continuing scheme. Even if, let's say, you invest into a scheme which is a 3-year average maturity, it doesn't matter that after 3 years it will cease to exist. It will continue as it is. It depends upon the rate cycle in which the economy is. And depending upon that, the portfolio manager will keep on shuffling between the duration profile. So I think on records, I want to put it this way that many of the people believe that your investment horizon should be in line with the duration of the fund. I think that's a myth which needs to be corrected. It should be more seen as a part of a core allocation to the fixed income. And within the core allocation, it can keep on shuffling between the products which are like low duration or high duration, depending upon the rate cycle. The way we are into the rate cycle as of now, we believe 1 to 4 year space should be a majority of the core allocation. And then, possibly after a year or 2 years later, one can decide in terms of a reshuffling. But as of now, it looks like 1 to 4 year, 75 to 80% allocation, 20-25% of the allocation should go towards the 10-year space or so.
All right. Okay, we would have loved to take this conversation forward, Mr. Garg, but I think we are now out of time. So thank you so much for joining us today on the show. And I hope that this conversation will really help our viewers as well as they go around in their fixed income investment journey. And with that, we're out of time. So we're going to wrap it up on The Money Show as well. Thank you for watching.